So let's talk about some pros and cons. So ETFs have tremendous transparency. You can see what's in them every day. Mutual funds update their holdings about every 1 to 3 months, I believe, by mandate. ETFs, the vast majority of them, you see today what they held as of last night. That was the whole purpose of them coming into being 30 years ago, to provide a different way, a better package, if you will. They are plenty liquid, and if they're not liquid, there's a way to find out. That's probably beyond a basic introduction lesson here, but if there's a 201 version of this course, probably would talk about how you figure out liquidity, and I'm happy to take any questions on that too. They are very efficiently traded. Think of it this way: you can slice and dice the market. You can say, hey, I'd really like to own that energy stock or that industrial stock, but the next time they put out quarterly earnings, it's kind of like a roll of the dice. It's a real crapshoot, and so maybe you want a little bit more cushion around that. So earnings blowups, I crossed that out on purpose because those types of sudden events, they don't go away, but they are definitely, the impact is reduced when you have a little bit of cushion, a little bit of diversification behind it. You get this kind of look-in ability to see what's going on. I mean, anytime I buy an equity ETF, I go in and I start tracking the individual holdings. I'm a chartist. I will chart all the stocks in there, or at least the ones that make up the majority of it, because I want to see what I'm buying, kind of under the hood. They are baskets of stocks or bonds or commodities. Again, you can kind of, sort of like when you have that hard to scratch part on your back, okay? You don't have that problem with ETFs because, like I showed you a couple slides ago, there's an ETF for just about everything now. And in a lot of cases, there are multiple ETFs. So you get a chance to kind of comparison shop. There's a wide range of hedging techniques available within that, and I just think overall they're a great toolbox for portfolio construction. So what can we say against ETFs? Well, they're not as sexy as individual stocks. I'm sorry. You're not investing in a business. You're investing in a basket, basically, of securities, but you know what that basket is, and you also know when the basket's going to change, because that is communicated very clearly by the ETF product makers. You could get a little bit of a drag from diversification, but honestly, there are always market segments and subsegments that beat whatever your benchmark might be, S&P 500 or otherwise. There's always plenty that beat them on the upside or beat them on the downside, because there's just so many more choices. The key is to be able to do the research to sift through them. That's what I do, for a living. The fund names can sometimes be deceiving, so you have to make sure that you don't fall into sort of the trick of thinking, well, I thought I was investing in companies like this, and it turns out it's a little bit different. It is definitely a different type of research. It is a combination, really, of equity research and mutual fund research, but it's also a bit on its own as well. So, again, sometimes people say, well, I don't want to just match the index, but when you have over 1,000 indexes to choose from, you can mix and match whatever indexes you like to try to find outperformers and avoid underperformers. So again, that's why viewing them as a set of tools to construct and rotate portfolios, I think, is an ideal fit for modern.